Hey, greetings, traders. I am happy to bring to you another edition of Macro to Micro Power Hour. Jonathan Gibbons from fintech has joined me again so we can talk about the markets, particular sectors that are of interest right now, especially China with President-elect Biden, and some particular let's just say noteworthy events going on behind the scenes. But what I really want to turn attention to at the top of the hour, Jonathan, is what the hell happened to volatility last week? Because we were kind of in a zone. We were having the week before last, a great call for a volatility, burst. It happened. We were on the right side of that. Then last week, we're talking about the dollar bounce that looked foreboding, if you will. It lasted really a New York minute and then went right back down. Luckily, it's, stabilized again, but at least for my, precious metal shorts. And then of late, we obviously have had a very large rotation from growth to value. This week, I'm wearing my Harley Davidson t-shirt in honor of great big explosion higher on Monday. So I wanted to get your thoughts right at the top of the hour, if you will, on volatility, because the shorts were right.
Yeah, I think so. I mean, that's the way it shook out, right? One of the most interesting things was it was compressed really late. It was I mentioned it yesterday, the day before, I can't remember, in the daily kind of write-up, that at the end of the day, the term structure was really expensive. And I think a couple people had noted that it was one of the most expensive elections on record. I think there was a bunch of charts floating out about that. And so it was really ripe for that. And a lot of people put on protection, I think, like really late. And so, there's a couple different scenarios. Different people talked about it. So I don't want to steal their thunder. I think probably the most logical thing is there may have been some folks buy puts really late and then, jump on the long ball train very late, and they just got sucked out. And it kind of, if you look at it, it was a lot of overnight gap last week. So the gap, ramp, and camp functionality all the way through the week from Tuesday on, that just crushes everything. So I think it was, kind of a multitude of factors. There's a couple of things floating out there, on it at the end of the day. Yeah, I would have expected it to totally been torched out early this week. And you saw that kind of change yesterday.
Yeah.
And there was a big shift yesterday, and I'm sure you probably talk about that in a second. So I think it was, a little bit of single name, like not single name, but just let's say tech exploded last week and it's heavy in the index. And, calls went crazy. People were chasing it. So it was like kind of really exacerbated moves. And then it got, vol just, everybody could sit on it and it could just ride it right down. So I think it was kind of a multitude of different factors last week. And the election being overpriced was, naturally going to mean revert once it was done in any way, shape, or form, or perception that it was done in any way, shape, or form comes to some sort of conclusion in people's mind. And so I guess they felt like it was done. And then, yesterday we find out that, it's not done. So it's done, but it's not done, but it's done. So, we'll keep playing this game, I think, a little bit for a little while.
So where do you think it goes from here?
Personally, I think, you saw, we were pretty loose last week ourselves. We were pretty flat. Didn't ride the up because I didn't think it was very, it didn't seem very healthy, right? It was very fast and it was very speculative and it was very call driven, right? Kind of Momo with the overnight stuff. It just gets, what was that? What did we say? Semiconductors, I think, were 2 standard deviations. I don't think the S&P made it to that last week, but that was ridiculous in 3 days, 4 days. You saw it get sucked out almost 10% in the last 2 days, semiconductors, right? So, when it's dicey like that, we kind of stand aside. I think you saw the dollar kind of spike with Trump. It was the dollar's trying to find its footing last week. Is it going up? Is it going down? And then you saw it kind of settle in yesterday and take off. And you saw bonds really get cooked yesterday. You saw massive cross asset volatility.
I've been a bond bear for a while from the 172 on TLT, but I admit I had long TLT into the election because I just didn't think that yield spike was going to hold, and it did fall, but then obviously went right back up in the reflation trade with it. But yeah, in noting that heavy call buying last week leading into the election, which you and I both agreed would be contested, just the hubris of Trump is too much.
Right.
You know, to let it go. Biden clearly, you know, electoral and popular vote, president-elect in play, the reflation trade, but it wasn't really until Monday that we had the explosive move. But I didn't have a really good feel, I'll admit, for volatility last week. We nailed it the week before. That was perfect, great shorting opportunity. But the crush, the VIX crush, I basically kind of, I hate to say it, kind of weaseled out by telling clients, you know, I'm fading any direction, like literally fading any move on November 2nd, like we don't know. But the big deal for me was very simply, if VIX falls below 30, whenever that happens, and obviously it did, dealers will be forced to re-hedge, which will add fuel to any SPX rally. And if VIX is propelled upward past 40, then dealers will be forced to sell futures. That's the trade.
I don't think I think that's really spot on. I think anybody that's sitting there, you know, last week you would have had to have been highly speculative, right? I mean, you know, it was into the wee hours of Tuesday morning when the dollar was in 94-ish. I'm not looking at a chart right now, but it took off and then it got crushed by 2 a.m. I mean, you would have had to be so fast. And that's what I was referencing last week. We're heavy in the futures market right now because you can get smoked in regular trading hours on these positions if you're not in you know, delta hedging overnight futures. Well, I think that kind of flows with what you're saying. Like, you know, I don't think there's any weasel out in that at all. I think that is pretty accurate. Those were dramatic.
I felt like I really know. I know what happened the week before. I'm good with that call, but I really was like, this could go either way. But ultimately, it was crushed. And the short, those who were heavy, you know, on the volatility short trade, remember the big whales that came in, etc., they were right. So right now we have, you know, the short dollar trade, which has a little bit of capitulation going. In fact, I just tweeted out today a chart on that, and I think you retweeted it, but I'm not quite sure if you can see this in here. Where is that puppy? It's a good one.
Yeah, dollar shorts came off a little bit last week. That was the first time.
Correct. And there it is. So, but my point was record 30-year US Treasury short as percent of open interest. And
yes, I did retweet this. Yeah.
Huge. Yes. And VIX coming off its short, right, of a lifetime, if you will. And they were right. Dollar to me looks now a little bit more bullish. What's your view on the dollar? Because VIX got just crushed last week. We had a ginormous rotation trade Monday. We have dollar short starting to cover, but again, everyone is positioned for reflation. Danger. That's what it says to me.
150%. Like you saw. So Friday, right? You go into the weekend. Saturday, everybody's all excited about the you know, the tech. If you're in, you know, you're in tech, you know, it was a great place to be. Biden wins, you know, reflation. Monday, like at what, 5 a.m. coronavirus here, right? And you're on the literal wrong side of that trade at the moment, right? Because what, airlines up 25%, right? You know, banks up 10%.
I have to tell you,
tech stock got crushed.
I was going to say some folks flew out on Monday. There's no question that there will be that factor rotation into cyclicals. And I'm a value rotation girl. Like I love to.
Yeah, I've heard it a lot.
Yep, the yield pops, the value rotation growth. I love to short. I love to go long because of these big pops. But that was really, that was an unprecedented factor rotation to the tune of 10 sigma move, which
insane.
Insane. So I actually jumped in here without even doing any background description on what we do and how we do it. And I apologize for anyone who's new or who comes in to watch this later, but this is like our third show. So I'm eager to get your thoughts on this because this makes the world go round as far as I'm concerned. Volatility for me is always the trade, and dollar as a backdrop. You actually trade the dollar futures itself. I use it as that rotation for, yields and tech, and of course, precious metals. So I use it as a macro. You use it very much in your prop trading. So I didn't want to, apologies. I didn't even do a bio, an intro here. We just kind of
We'll
like
keep
jumped
going.
right into it. I'm so
We'll do it
excited.
at the end. Hopefully it's good enough that they stick around, right? So
Exactly. But let's back up a little bit. This volatility crush that happened last week, obviously, that accomplished its goals of serving the shorts right. They made their money. Big whales came in, right? They positioned for volatility to get crushed election week. It worked. Granted, we're still in the 20s, not the teens. Where do you think we go from here? Since to me, volatility makes the trade two-sided. That's what I like about it.
yeah, I've been kind of hammering the same major points, right? So you've got debt, right, which the Fed came out yesterday at the end of the day and commented significantly about concerns with debt. They came out yesterday talking about concerns of a dollar shortage. Now, why would they be talking about concerns of a dollar shortage? So last week, I think, at the end of the day, was pretty noisy, and we have some clarity this week, but still not a ton of clarity, any different than we really had last week, as Trump comes out after the coronavirus, claims the coronavirus cure is his, and then he's challenging the accounts again. So there's a lot more volatility in that case. With the rotation, and people are dumping tech like it's their job. Flows are just dropping out of tech. So you've got rotation, but is it going to stick, or is there something else cooking here? And we thought there was something else cooking yesterday morning, seeing all the cross asset volatility, which was significantly, kind of record setting across the board. I don't know that this rotation per se sticks. We have to see. There's some huge gaps that need to be, hold half and go, or are they gonna get closed? Like I mentioned yesterday, that you had by the end of the day, the Qs opened 3%. They closed -2, something to that effect. The SPY almost got there. You had all the leaders like the FANG, most of the FANGs crushed. I think that there's something. This is tremors, right? You're seeing tremors. I don't know that you can say, what was it? AMC movie theaters announcing they're closing theaters, and they were up something 30% on some squeeze. So basically, everybody was on the wrong side of the trade at the open in the morning.
Well, I think it's really exciting, actually, because these, I'm going to call them massive, this factor rotation, short covering rally in the oversold, left for dead, economically sensitive plays can turn into trend reversals in time. But I think it needs to do the back and fill and, perform like other stocks would, which tease out that yield pop thesis a little bit more. I don't believe, that this is going to be from, this gap, this massive gap. Basically, when I tweeted this great chart, which was basically just a record 10 sigma move in energy versus NASDAQ yesterday. So that is definitely a phenomenal kickoff to a trend reversal, but it typically does the job of filling that gap first. Pot stocks kind of led that. That was a beautiful thing. They look like trend reversals, but I in no way would I be chasing it up here. It's already given back half of it. So that's what I expect will happen in the same space. I'm actually going to be interviewing an oil trader on Thursday to get that kind of fundamental with just everything background, because that's all he trades is oil. But this is a big deal, the energy complex. That's, my thesis is that we need to have a little bit of back and fill, constructive yield play, if you will, to the downside. After, I think TLT is going to probably fall another $1 or so, hits a really major trend line. I can actually show that. And then we'll see if that actually gives it a nice, here, let me just see this trend line. So kind of moving in, it's about 154. I don't know if you can even see that, but anyway, 154 on TLT should have a little test of this reflation thesis where bonds pop, yields come back down, and with it, this energy rotation that we saw today get tested and kind of fill in some of that gap. That's what I'm looking for anyway.
No, I'm totally in agreement. I think it's too early to call anything at the moment. I think the situation is a little dicey though, right? Because you've got coronavirus going to cause lockdowns all across the winter. Whether people want to say that the government will lock down again or whether they're going to self-lock down. But I called that back in the fall. How does that affect energy? I mean, demand's going to get crushed. Is it just a rotation on an expectation? Sure, it can happen. But is it going to come play all the way through? I think that directly impacts the reflation conversation. The Fed's talking about deflation, right? They're terrified of deflation. Nobody can get inflation cooking in these things. They can't. These things are left for dead. And then you've got credit, which is significantly an overhang too, which is really driven a lot by what? The explorers and the energy sector. The credit's very bad. So, is that fixed? Right? Or is that somehow like, what's going on with the dollar, right? Why is there?
Well, before we get to the dollar, I definitely want to also highlight a tweet that I sent out by Robert, the oil trader that I'm interviewing on Thursday. And this was, he was long the integrated, the Exxon, if you will. So it was definitely very successful. Every time it's gone down to 32.70, basically, I've recommended it to clients in the past few weeks. And then, of course, I was not expecting this ginormous move higher. But nonetheless, it is the number one, right? So it's safer to play that over some of the other, definitely lesser oil and gas companies, but it's the number one integrated. But he tweeted this out today. And of course, I forwarded it along, even though oil has obviously popped up considerably. Begs the question, did crude get the vaccine or the placebo? It might just matter at range highs. So he's a little cryptic. He's not when I interview him, don't worry, but he's talking about open interest. So this really is a pop, but is it sustainable? Is there really open interest in this contract to sustain this rotation? So we're going to talk more about that on Thursday. But okay, yes, that's underpinning for a lot of the commodity reflation trade that happened on a Pfizer vaccine announcement, which was very positive, but for a very small segment of users. So of their like 44,000 in the participating, I forget how many, 70 were actually sick. And of the 70, it had very high efficacy, but safety is to be determined. So there's got to be more time. And I'm kind of like, trust but verify mom. So I want to see more come in to support this. But that is what drove a lot of this with the yield pop. I still think we're going to have it tested definitely in the next coming weeks, especially with the contested election by Trump and all the shenanigans that are going on there. So what's your time frame for kind of the dollar, since that impacts commodities, and this reflation trade? What's your thinking as far as time frame?
I think this week is huge. I don't think that we're wasting a lot of time here. The dollar was sitting around basing yesterday morning and didn't even blink with the spike, which I thought was extremely irregular and why we jumped in right then. And I think that by the end of the week, we should know a lot more from volatility space, from the dollar. Right? Is any of this going to stick? Because these are huge, like, you got like what, 6% gap, just huge market structure gap in banks in XLF right now. Is that gonna fill, or is it gap and go? That's a huge market structure, unpriced, no price discovery yet on that. I think that this doesn't necessarily mean that the reflation trade is dead, and it doesn't mean that rates won't come down. And this spike is just, it's shake, but you're talking, it won't settle out. Things can settle out. Flows won't lie. Flows are out of tech again today, heavy, and flows were not really in to, AXP, American Express didn't follow through, banks didn't follow through, nothing followed through today. Everything kind of held its own, which to an extent is some messaging, right? But I think, I'm looking for those to crater, right, and fill this week, which would be really, really, that'd be shaky if these things don't hold a week. If they hold a week, right, to post them.
Oh, I get your point. Okay, so I'm looking for like a week to 2 weeks, but I am seeing a potential for air pocket as well.
Oh yeah, it's
Okay, so
there. Yeah.
we're using the same kind of thing. This back and fill, I don't know if it's going to be gradual or sudden. There is the risk of it being very sudden. The same way it went up can come on down.
Well, yeah, like tech and semis are exactly my point, right? Where they shot last week and they've given it back, and then the moves from Monday were already taken back and dropped. Those are impulsive. From a market structure perspective, that's completely unaccepted. There's no buyers up there. That's just sucker moves, and so those are now people sitting in the wrong seat, and you got a lot more selling than buying. And I just look at it very technically in that standpoint. That's really how we look at everything. And I look at these moves. So tech is leaking, right? That's in trouble unless something significantly changes. Then you look at the energy, you look at the banks, you look at the ones that were really that was a squeeze move. I think it was a squeeze move yesterday. People there were body bags, right? There were people that woke up Monday, and I'm like, oh man. I texted a couple people. I was like, it's body bags today because
I'm short financials. XLF, I did not think it would get above 25.50. So yeah, I'm holding, of course. But the point is, I see this same impulse of it's a great setup, which I happen to personally love. When something overreaches, it becomes what I call, a fake breakout leads to a fast failure. And I'm seeing that in the indices and then particular sectors that I still don't think are very healthy under the surface. And I would say financials and the indices across the board kind of fall into that category. The only one that has really broken down and apart, of course, would be the Qs. I mean, they gave up all of it and then some. But this is an article that I also tweeted and talked with clients about. The vaccine news is good, but here's the bad news. I don't want to say it's the same as, for example, Biogen that just a few days ago announced, Alzheimer's results in a trial, and the stock shot up 50%, and everyone's like, please, 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 because we need a cure, right? We need treatment. We need solution for Alzheimer's. And then it completely got unwound, right? So not saying that this Pfizer vaccine is going to be that situation, but it did gap up just like the rest of the reflation trade and then dropped 9%. And there was very heavy selling after that bump in Pfizer stock. So, to me, I like to look at the behavior also of the vaccine plays to see if there's really sponsorship, right? So I still have my doubts, let's just put it that way. But that whole reflation theme was triggered by a Pfizer, by the Biden, declared president-elect by the networks, then by the Pfizer announcement, and then that yield pop just sent the hedge funds who were massively short the economically sensitive plays, and they went higher. I don't know how much of that was unwound, but it was good to see some of the dollar shorts capitulating. But the 30-year Treasury shorts are still all-time highs, and they have not capitulated yet. So I still see some kind of rough and tumble for yields in the near future.
Yeah, I think market structure as far as dealers is concerned is TBD for the week. I think anybody that could sit there from last Tuesday to today and go, yeah, this is all normal, right? The non-volatile market, you got to be kidding me, right? You walk into last weekend, Biden's the president, there's no vaccine, everybody's buying Zoom hand over fist. Robinhood had problems. TD Ameritrade had problems executing on Monday because the bulk of their participants are in tech, right? And it was just a mass selling event, right? It was a mess. So you talk about like mispositioning on both sides. You got a lot of swinging going on here that it needs a few days to settle out, in my opinion, and the levels will drive it all. I thought it was very fascinating that yesterday the Fed addressed debt, commercial debt.
Yes, that's true. Household
debt. I was like mind blown yesterday, right? Of all times, and if you think about you think about 2001, you think about all these events that we had significant issues back even in February. It's always credit, right? So credit, bonds, and dollar, right? That are always, so it's debt structures and everything else that cause some sort of a systemic issue. And we're seeing huge tremors here. I'm not saying that we have a systemic issue here. I'm just saying that the behavior the last week with the spike on the gamma squeeze, right? And then the collapse of that.
I think it's been in place since June. I think we're in a distributive top since June. If I look at Microsoft and I mean, Google just hit trend line, obviously, but it's the better performing of the lot. But I look at Amazon, I look at Microsoft, they're huge honking head and shoulder patterns to the downside on a weekly. Now, I'm wrong if they trigger, obviously, after this, consolidation and they move higher. Head and shoulder patterns can also be continuation patterns, but I'm not feeling it. It's too violent. And case in point, I've got another chart that was sent by a colleague that is basically the high beta cyclicals. And I remember this extremely well because I was trading it long to, this May, June, and then it topped out in June and then collapsed very suddenly. Basically on the charts, it hit the 30-week. A lot of these economically sensitive plays and transports, the whole bit, they were steel, everything. And then they just collapsed and then they stayed sideways the past few months. And then just recently, meaning Monday, they exploded higher again. But take a look at also the equity, put call ratio down here in the bottom. That's not where you keep buying, right? I mean, can you see the chart?
Yeah, completely.
Yeah, so this is careful. This is extended. These high beta cyclicals were a fabulous run up. And I traded that. That was very nice. I had one, for Monday, I had GM. I'm like, wait a minute, where'd that come from? So this is, to me, it warrants some caution. It's a little bit, for right now, I still see, and we talked about this last Tuesday, I still see buying under the surface. They're still coming in. And yesterday was one of the top 10 option flow days of the year. So, we still have the optionality, which is huge volumes. I definitely see that cumulative volume under the surface continues to go up, but that's why I'm waiting for this kind of overreaching, it gets extended and then it has the energy to really fall fast. So maybe I'm wrong, but that's what I'm looking for. And the caution, like we just talked about with the cyclicals, it could be an air pocket type of event like it was in June. I mean, they just all of a sudden, after running for 2 months, they just decided to say, we're done. And boom, they just collapsed.
Yeah, I mean, the flows are still there, like you point out, for options. The flows are still there for, just underlying today. It was pretty consistent. Nothing really dropped out heavy. I just wonder if these are sustainable levels of value, right? I mean, 10, 11 points in banks in a day, on what? Yeah, I mean, a rotation, but I'm not saying that it's crashy, to be honest with you. I don't know that that's the case or anything to that effect. But I do think that if it continues to tremor and you're looking at, what is going on with debt, what's going on with the banks, the Fed's crying from the mountaintop yesterday, as clear as day. I retweeted all those yesterday as like, what is this, right? Like, look what they haven't said this at all, and they're screaming that we've got problems, like we've got a significant problem. So I think that there's more likely some mean reversion first, and then you're going to see your internals, your usual internals that you track, right, with cumulative volume, with advanced decline, right, all of those type of structures, start to give you a little bit of tell. Right now, you're still in kind of this like hurricane situation where is this wind stopped or is like something else going to fly out the door? I think you don't know enough till maybe the end of the week, and then you can start to see what those do. Because I do believe that those internals you track they're the money, right? And if they're not blinking, then you don't blink. But you just got to be cautious, right? Until it shakes out. But because I mean,
might be the minority though, because it's tough. You got all kinds of themes here, right?
Well, I mean, theoretically, right? All things being equal, if you get fiscal and you get monetary, right? 4,600 is not a good enough target. You probably 5,000, right? Because this is going to all run hot. But
you use this in your juicy report every single day, right? The market nirvana. I think he stole that from you. No, just
he
kidding.
may have, right? Yeah, equity nirvana, right? Yeah, that's what we call it.
Exactly. And all the reasons that you're talking about. So it's in sight. Well, maybe not in a straight line, but it does seem the past, week post election, blue wave, if you will, higher probability that there has been some steady buying. But I'm still waiting for that turn. Haven't seen it yet.
Yeah. I consider it like this. It's the poker table, right? So you got guys at the poker table, ladies at the poker table, and they're sitting there and they're making bets. The bets are still at the moment, right? Based on the options, flow, and based on the actual underlying flow, that he's picking, he's cherry picking right here. They're probably, this is exactly what everybody's thinking is the path of least resistance, right? We're going to get fiscal, we're going to get monetary, we're going to get the, what was it? I had a bunch of guys shoot me stuff yesterday about the pot stocks, like you mentioned. What is the one of the first four things they're talking about is Green New Deal type infrastructure spending.
Yeah.
With unionization of a lot of different things, whatever. That's all like inflationary type action. Then we get the action on Monday, right? Which is reflation, noflation, deflation. Which way are we headed? I think that until there's definition in the liquidity situation, which there just isn't right now, there's assumptions. And assumptions, and I've said this a bunch of different times, are different than definitions. Like until something is 100% set in stone by the House and the Senate and it goes through, then you've got a bunch of back and forth. So it's just, I'm assuming maybe I've got inside dope, maybe I've got inside information, whatever, but it's still assumptive. And the same thing goes for the Fed. Everybody just assuming the Fed is, right, just going to come in and do whatever they're going to do, which is what they've explicitly said. But yet yesterday, we look at a lot of the word choice, that NLP, the natural language processing stuff, and you can see that they changed their tune yesterday. And I don't know what that's about. And, it was pretty poignant. I think everybody should take a look at that. All of the documentation from yesterday, just take that, set it aside. Because it's easy, path of least resistance for sure. If it goes fiscal and monetary, it's going to go much higher. If anything hiccups, right, everybody's offsides. And you saw what offsides looked like. That's yesterday. Everybody's offsides. Like people were long tech, heavy options, crushed at the open.
I had just tweeted this on the 8th, right? Hedge funds all in. It was over the weekend. Yeah. So JP Morgan, by the way, this same guys that are saying 4,500, in short time here, or coming up, are also saying both gross and net exposure levels are at the 100 percentile. So it's since January 2018. So this is obviously what we talked about 2 weeks ago, where hedge funds were fear of missing out, being long into the election as if it was career risk, right?
Yeah, you had said that. Yes, correct.
So they buying begets buying, and I've seen it underneath the surface. Now the rotation, obviously, that tech, rotation, because yields, because reflation, they're short covering. Goldman said election day saw violent short covering, largest one-day global net buying since March, 3.6 standard deviation, driven by shorts. I can't wait to get the number for Monday.
And you think about it, and a lot of that's given back already this week.
But this front running the year end. So I think it was you who were writing kind of about the 11/20 options expiration, right? And this is before December gets really muddy with, maybe the December 11th government shutdown risk if Trump's in a bad mood. But definitely year end puts have been large for December. I'm wondering, you track this. I haven't looked of late. Have they covered? Because it looks very much like the past, 2 weeks have been front running a year-end rally. Now that we have exploded higher, what's going on with the December puts as far as
I don't. Yeah, I think we've taken our perspective to week, right? Because we're in some fairly uncharted territory here, right? Where some of these cyclical stories aren't really applicable, right? We've got, what is the December story with 3,000 deaths a day in the United States for coronavirus, right? And at the rate we're trending, that's a real number. 2,000 to 3,000 is a real number. So, are we in a normal Santa rally, or are we in just this options fueled gamma squeeze, equity nirvana doom loop back and forth across asset classes? And I'm side with that. I think that, whatever the options positioning shakes out to be is going to be, a lot of guys have talked about the Vanna concept this week, and, they've been really covering that. I don't need to dig into that, but that is supportive, upside drift type thing for the markets in the options environment. And it's definitely there through 1120. But, then as these tremors and these earthquakes keep taking shape and keep happening in wild swinging environments, what kind of repositioning does that take shape for the month of December, for the month of January? I don't know that it's a normal assess it as it's always been, book clearing type, run up, exit, tax lot type stuff. I think it could be a lot different. I think it could be a lot dicier. And I think we think that you got to really eyeball the dollar because it tapped that long-term trend line on Monday, and on a 7 or 8% up move on XLF, and a 10% something, and a bunch of the other soft sectors. And then you got airlines up 20%. All of these Dow type elements were significantly up, and the dollar didn't blink at all. And then it rallied. And VIX was down 15% at one point intraday and rallied and closed green, something to that effect. 12 to 15.
Oh yeah, it was like 30% in just a few days.
Yeah, I mean, these are like set the kind of the narratives aside, and you're really watching options flow from here. And I think it's going to be a really good play for everybody to be cognizant of how that shakes out. And then you got to see that, you've got to have confirmed stimulus fiscally and confirmed monetary. Monetary is pretty much a given, and they're going to do whatever. But you got to have the fiscal confirmed with it to get to these numbers these guys are talking about, which is totally viable, but it's not in place, I don't think, at the moment. You're seeing a lot of, TLT crushed yesterday, right? Like these are huge. Gold was about 5% almost at one point. Like that, gold's a collateralized asset. I mentioned that last night. These are liquidations. That's liquidation. That's.
It's still on support though. That GLD, particularly 174 and 1850. So if that gives sway, those are major levels.
Oh yeah, I think, Chris,
not minor, major levels.
We're huge pivots. I said on the weekend, I said that gold and silver was at a really interesting spot. It was at kind of where it was going to pop and break and test the volume point of control of around 25 for SLV, or it was going to turn, and it would be so gnarly if it turned. Because people were getting all in on it again, and GDX in the same boat, and they just got crushed yesterday. And now they're not in a good situation from a market structure perspective. And they got repair a lot of damage pretty quickly. Well, how do you repair damage if it gets deflationary, right? And then you trade it out, right?
Is it a deflation impulse that's basically leading and telling us careful, careful? It's certainly not a play on the dollar because the dollar has really not moved very much, right?
Correct. Yeah, not yet.
Yeah.
So yet. I think it's you got to wait and see, and it's watch the stimulus, watch the cases, watch this, all this gapping that happened yesterday. Does that fill? Does it not fill? Or is it gap and go? Right. I think into the week.
Because it can be also fiscal related. I assumed back in August when I knew that the fiscal wasn't, going to be tangible and real, they were just kicking it down. Gold continued to fall and falter. And obviously real rates are impacted. And we've had that nice big bounce in the German bond and the 10 and the 30 year. So it's definitely all related as far as macro. But when stocks sell off, so do the miners. So this to me is still at risk, although I know lots are expecting this to be, the safety trade. VIX has come down. I think that's a better safety trade. TLT has come down a lot, but that's not so easy anymore.
Right.
Definitely, I think that's a harder one, just because of all the manipulation, the intervention, let's put it that way.
Right.
So
Right.
how are you hedging? Like, how are you just doing directional, or but for a portfolio?
Yeah, we're not like I won't get long here, right? For more like we're very active right now. That's how I would put it, right? It's highly active, and sometimes you can let it ride, right? And if you're in there early last week and you bought at some at the intermarket kind of levels that your signals were probably given there early last week, you could let it ride. I don't know that you can let it ride right here. I think that if you're actually trying to see what shakes out, you got to be tactical. But then once you get a directional trigger, which as I said last week, I still didn't feel like we had. I mean, everyone's like, oh, it's good. It's inflation. Biden, it's inflation. We're going to get, they're going to make a deal. Even McConnell had said over the weekend, he's like, yeah, we'll find a way to do a stimulus together. I mean, that was like one of the things that I read and sent to somebody. Come Monday, we're like, yeah, we're going to recount everything. And it's not over till it's over. I think being just long and blind here is going to be tough. I think if you're hedging, right, your longs, right, you're really going to need to collar stuff. You got to take the air out of the ball, because these air pockets they'll wipe 6 months out on you, right? Like
I have to put this in here, because although you and I are shorter term, right? So you're trading at your prop trading biz. I run a live trading room. I trade for a living and support clients who do the same. This, however, this backdrop of this podcast, I don't know if you've heard it. I know you're a big Chris Cole devotee.
Yeah, huge. Yeah, great. He's great. So's
and it's a long podcast, but I'm making dinner or whatever. The delta hedging of options will actually become more volatile to hedge the option market the lower interest rates go.
100%.
And I keep looking at that going, I'm expecting, this reflation trade to peter out and then reverse, right? And then bonds pop up again, stocks come down, and there's going to be this jig jag. But as rates keep going, soft, and now you heard Janet Yellen is up as rumor for Treasury Secretary in Biden's administration. She's never seen a yield pop she likes, right? So I mean, this is going to be interesting. But yeah. I really like this quote that I pulled out of the podcast, as it relates to negative interest rates too. They can cause options to have a higher delta exposure to the underlying than one. Do you want to can you see that quote?
Yeah.
Okay,
yeah, absolutely.
So translate that in your world. I mean, this is the Christopher Cole quote on the volatility. In other words, hedging, if we get into this type of situation, because the derivatives market now is kind of leading the equities market, right? We've talked about that. The flow is bigger. It's pushing the dealer hedging. How would you interpret, I know I'm putting you on the spot. I didn't give you any of these, questions before the test, but how would you interpret that?
Well, I mean, when you've got the options market, the size of the options market in a lot of ways has taken over the underlying securities. We've talked about that. And so it's a derivative driven market, not in 08 or even, in other periods with currencies, but where you had the CDS type environment that was, multi-layered, it would just crush it. Now you've got options being traded at such a larger capacity than ever before that they're driving the repositioning of all the underlying and can wipe it out or just drag it up, right? And the way I would say it is, as rates continue to drop, right, and the negative interest rate, there was a Hugh Hendry tweet. I know you follow Ralph Paul, yep. Look that up later.
What is it again?
It's Hugh Hendry and then Ralph Paul. So Ralph Paul retweeted from Hugh Hendry, and he was going off, and he went on this real long thread redraft unroll type thing this morning about exactly this. And I think everybody should read it. And he was talking about how negative rates are correlated to, with treasuries, right? And what that impact could potentially do with deposits, right? And then you look at what this does for the negative interest rates affecting options, right? It's a risk environment. It's negative rates push people into risk. that changes the whole paradigm and infrastructure across asset classes. And when I see this, that's a very kind of baseline terminology, but to take a step back and look at it from a macro perspective, it's that risk is being pushed into other things. And that's why options no longer would be hedge worthy, right, to an extent. And I find futures to be much more useful nowadays than options, because the Greeks and the implieds can be so skewed based on the volume of activity and the velocity of volatility that you end up with delta exposure, right? Have higher delta exposure to the underlying trend line. So you're literally changing the stock price of the underlying, right? Because it's going to cause such an impact of the underlying, if that makes sense. And I don't know if I'm explaining it properly, but when something becomes larger than the thing that it's supposed to be a amplifier of, right, it eats it. And therefore, the rate of change can become larger than a singular value. So it's a mess.
Here's a chart I want to show you, because I asked you again. I didn't give you the questions before the test, but you and I are, and you're much more, I guess, well-versed, if you will, in the risk parity fund flows. I follow that whole factor rotation because I want to time the sell-off in tech and the rotation to value, right? So to me, that's very profitable. But I'm looking at this and I'm charting everything, right? For me, I'm looking at the macro, the fundamental, the sentiment, it doesn't matter, the technical, the intermarket, and the quant side or the risk parity side. I actually grabbing this ETF, which is RPAR in my TC2000 software. You can see from the March lows, right, where it's just been grinding higher. And then I mentioned, I can see some distribution going on in big tech for the past few months. But this looks very much like a bull flag breakout that just got retested and came back down. So this is bearish. This is choppy. Where this goes, I don't know. But your thoughts on this charting of risk parity, which I know is a no-no because flows are, this religion to a lot of GECs and, VIX traders. But what do you think about that chart and my attempt to show a flag as a potential breakout, bullish or bearish?
Honestly, it could be, the two things could happen here if you're looking at it from a sheerly like technical perspective, right? Like it could be a gap and crap, right? Or a gap and go, right? If you're just looking at it from a strictly, technical perspective, because you broke out, you hit that upper Bollinger Band, and you came right back to the trend line. Now, is it fractal of February, or is it, going to settle itself out and continue higher? I think, honestly, just looking at this from the chart perspective, it's TBD, right? Like yeah. It's if you were to say that you know for sure that that's a full retest and it's ready to go, yeah, you could take that gambit with with a stop. But if this gives up that line and breaks down, that's a dagger.
Yes.
Yeah, right. And
that's the only reason I'm using that as like a backdrop. This isn't tradable, obviously, but it's interesting to kind of show that they have kind of a graphic representation of risk parity.
It's an overlay. This is an overlay, right? Like, and you see how significant the risk changed, right? Like it's fine and it's not fine, right? And I think that you saw go back and just look at your February, March tremors. It's not fine, it's fine, it's not fine, right? It's not fine, it's fine, it's not fine. It did tremors. What you really want to see if you're saying, yeah, is this smooth? Look at just the natural equity nirvana that you had from April on, just the April to August period. It's a one-way street. There's not any fear. There's not much concern. We got this under control. We've got fiscal. We've got monetary. Well, now it's gyrating, right? And gyrating can break either way. What I will say is it can break either way. And you saw that kind of last week. And what you saw is that people were like, there is so many trillions that have been created that there is an infinite amount of liquidity. right, sitting out there for people to put to work. And you saw what happens last week with those flows. You mentioned a bunch of them here. But when that gets choked off or flips, and then you pull out the underside of that with fiscal or monetary or both choked, then this can get ugly real quick. And you saw exactly what can happen, because theoretically there was a bunch of research done about, kind of some mistakes in February where they got caught in the wrong spot. It was just kind of a Murphy's Law moment with the Fed. It was just the wrong thing at the wrong time. And they just got caught. And then they reacted very quickly. That's 3-4 weeks. They reacted very quickly. But you at this moment, I think, is even more kind of dicey to an extent, because you don't have a sitting a fiscal group in place. And that's going to be argued till the dead end of it. And you'll see people take anything's kind of gambling in that respect. That's why I think you have it sitting right there. Like if you show back just the chart for a second before you look at this one, the other one right behind it.
Yep.
On the far left.
That's just a weekly. Yeah. That's a day perspective.
Yeah. Look at the weekly. Just look at the weekly. Cleaner. It shot out of a cannon, right? Which is, risk on, right?
Yep.
It was risk on going into Monday morning, and it's risk off, right? By Tuesday afternoon. Where we go the rest of this week, that's why I say this week's pretty significant. And into next week, right? With options expiration, then you find out. I don't know that we know enough at the moment, but it could go either way, right? It really could go either way. There's enough. Chris Cole, as we brought him up, he said it's like smoking next to a plant of nitroglycerin. There's plenty of nitroglycerin at all times right now, but if there's no fire over there, those canisters can just sit there for years. So that's what I would say about the risk parity chart: is if nothing sparks and it settles out, and all this stuff settles out, and you get stimulus, 4,600, 5,000.
Yep.
15,000 NASDAQ. We printed so much money, it's going there. But if it doesn't, and you get a spark, or you start to see your internals move like you do track them, it's coming. So I'm sitting in the week.
But this is also important. I mean, this rotation that we had back in May, right? I showed you the cyclical, and the put call ratio was, all-time high, and we have it the same, right? That chart from before.
Yep.
Well, here we are. Here's the 30-year yield, right back to that June before it crashed down, right? Here's a trend line. It broke, settled down. By the way, that's a 10-week, which I happen to use for trend reversals. So it's performing well if this was any stock, but it's right back up to where it was back in June. Again, big picture, it has made some very decent moves off the bottom. Same thing with the 10-year, right into the yellow happens to be, a quarterly resistance. We get above that, tech is going to crash because this higher yield regime is obviously not expected. So,
and a good point there about tech. What's the bulk of the indexes? They've all rotated to tech, right? And we were talking about that yesterday morning. So you've got an overweight infrastructure on the indexes that's sitting on tech. So these things are all, I said yesterday, it's a bunch of unintended consequences. And that really, when you have a bunch of debt and you have an unintended consequence, maybe it's a rotation that necessarily shake out. What if it's a rotation that pushes this up, right? And you get tech crushed, tech drags the indexes down for selling it. There you go, right? It started. So I think that it's a tinderbox that if you make sure that there's no fire lit, right, there's no spark, then it can solve itself out. It'll settle. These come down, and we go on our merry way. I think that's
option flow smells it, doesn't it? I mean, take a look at yesterday, for example. This is done this morning, so it's the 9th. Yesterday was the busiest day ever for the U.S. options market, with about 48 billion contracts changing hands. There have been others in that same kind of vein as far as total flow. 9 out of 10 of the most active days for listed options have been this year. So the options are kind of moving this market. And I also note that they are at inflection points as well. So where are we right now? This obviously leads, but it's fascinating how Are they positioned? I don't know. They're coming
Well,
in.
yeah, this is why we're putting options in the charts, right? So within like a week and a half, 2 weeks, there'll be options where you can where you look at profile volume. Usually, you can be able to look at the open interest structures, checks, executed distribution, unusual activity type stuff. Because it's like literally the levels now. These are the levels, and they need to be translated over to actual visualizations for price discovery, so that you can kind of have some merit where the goalposts are moving from a regular basis, because the game's just changing. Yeah. And you got to just move with the game. But I think yeah, the options are moving, but is it just another version of where people are positioning? So they're just different poker chips, right? But they have unintended consequences. I think yesterday was fascinating to me, and is a huge bellwether for moving forward, is that you had a vaccine announced and everybody was off sides, like on the wrong place. And what does that impact? So if everything's a derivative driven environment and it's a good thing, wait, it's a bad thing because everybody's on the wrong side of the bulk of the options market. Shit.
So now we're going to talk about China, because we're getting up to that hour. Something I want to show, because we got to get into that, because we have some trades that is, for example, BABA singles day today. Of course, they beat records, and yet BABA fell apart at the same time on this, rotation move bigly, right? So this is just kind of switching over to the China play, because we've got lots of quote unquote liquidity there. What's your view on the China? One chart I want to show just as a talking point is this VXI. And the reason I want to show it is because this, whether it's a monthly or a weekly chart, I can make it look tighter if it's on a monthly. Look where we tagged literally yesterday. I showed that to clients. This is a monthly trend line. It's a big old wedge. We broke above, we tagged. There were lots of options to the bullish side also for FXI, and it has been pretty bullish because they contained COVID earlier. They, resumed, et cetera, et cetera. And then today came right back inside, and some of that obviously can be seen in the BABAs, of the world. So we won't, unfortunately, get into kind of the nitty gritty of like the danger on the China side, but I'd love to know what you're seeing now in some of these, the kind of the setup for China, geopolitical risk, trade setups, especially as it relates to the beloved K-Web, contingency, which has been phenomenal player, right? Has not broken the trend. This is honking bearish reversal if this was a Friday, but it's only Wednesday afternoon. So, who knows? But the China trade looks like it is tagged some key resistance levels, and it's already immediately come back down.
Well, I have I made a PowerPoint with my whole thesis on China. What I'll do is I'll record it and then post it or something, because it's going to take 20-30 minutes to run through the PowerPoint, unless everybody wants to stick around. But
how about we do this? Because I know we didn't. I love this too. But we had dollar and volatility in the market structure.
No, I get it. I totally get it.
But I don't want to wear people out. It is 5 o'clock, and we did this for an hour. What if let's do this as a standalone, right out of the bat on Tuesday. What do you think? We just really start with the China plays, because I think that is going to add some value.
100%, because I think it's directly correlated to everything we're talking about, and I'll just sum parts of it real quick. So globalization, right, is very much a pro-China situation, right? And Biden is very much going to try and push that back onto the table, where we've been extremely isolationist. Now, there's a lot more to this story that needs to be unpacked, but the perspective was that you can see they go to the monthly view, and you can see where that tagged.
Which one are you talking about?
FXI, right? Real quick, you can see that tag right there. There's no doubt that China's growth story, with the size of their middle class, the fact that their middle class wealth is increasing at a rapid pace, just the statistics on the size of the country, and they're the mass producer of the world. This breakout is like, globalization. It happens. It just happens. There's no doubt about it. A lot of value to be created over there. If there's no globalization and it reverts back to isolation in isolationist type environment, that chart is going to reverse because the flows are not going over. They want to open that economy to the rest of the world. BlackRock just went over there in August, right? Citi is now doing a significant amount of investment banking over there. That chart changes in a globalist environment, globalization environment. That chart.
It's also a dollar play, many.
Correct. And that's the other side of the whole thing. And that's why I'm pounding the table about the dollar, because the dollar, if you really go through this whole presentation, the dollar is one of the last weapons that the United States is holding. And it's a weapon. It's not a currency. It's a weapon because of the SWIFT system, because of the Hong Kong dollar, and the United States is trying to hold on because we've lost all our production. We're not the net producer of the world. There's two charts that just make you go, whoa. Okay. And you hadn't really thought of it that way.
Then let's do that. We'll shrink up the market view to like 15 minutes and then just do China. Sorry, didn't get all of that pacing in my mind.
There's a lot going on this week, right?
This election cycle, the reflation cycle, obviously the dollar is still stagnant, hanging in there. I mean, you can see, I'm just quoting UUP, but still,
yeah.
Depending on where you look at it, there are some levels where it's trying to get back inside, but ultimately it can.
This directly correlates with your risk parity chart, directly correlates to your China chart.
Yep. So.
Right? Breakouts or breakdowns, right? Fake out, break. I mean, we're at an inflection point, I think, pretty significant.
So one more week or two, we're probably going to be down here, but for right now, let's do that. We'll end now. Thank you again. And Tuesday, do your presentation. I think that'll be fabulous. We'll just hit the high points of what happened this particular week. But until then, since you can see the FXI pulled back pretty strongly with BABA, falling 9% on Singles Day, which is their most successful, profitable day of the year. What is your play that you think is worth, mentioning into next Tuesday? Because we did the VIX the first week, dollar, election volatility the second week. What do you think we got, for the next?
For this week, I think it's a breakdown, like 3,500. 3550, right? And the SPY right now, or 355, 3550 in SPX. It could easily, that candle sitting out there, you could easily pick up 2 points if that thing gets back up over 3550 in the ES futures and then run fill that candle. The other side of this is if that breaks down, you could see a lot of rolling over. So it's a trend
line, from this 2018 timeframe. And then, of course, the February, March collapse. And then we tagged it. We came back in, which was basically briefly in September with that 14% pullback in Qs, 10% in SPY. We rolled over again briefly last week, 2 weeks ago, and then completely reversed into the election. We had 8% move in SPY, and the expected move was 4%.
Yeah, I think that 3393 level, if that's not breached and broken, then it could just be a retrace settlement and it's going to continue to go. I think that's how strong these cross currents are as far as the liquidity is concerned. But if that level goes, which I think the sub levels are 3600, sub that 3550, that's a gap that can get filled pretty quickly. Underneath that, you've got XLF, IWM, all the stuff yesterday, the gap, it can roll. I think there's some extremely juicy tactical stuff this week where if it does roll, it's going to gap clear quick. Like I think I looked at the Russell RTY earlier, and it was almost 3% or 3.5% hold that you would capture right on a turn. So I think that does any of that break market structure? That 3,400 level is a big level. If that broke down, you could see some things get dicey. But I think that there's some intermittent trading that can take place this week on some levels based, right? So solely on levels based trading.
And then after that, you're going to have a much better perspective where to put long-term capital. Are you going to be short? You can be net short, or you can be net long. You'll have a much better perspective of that as we get a clearer picture on what the dollar is going to do and where the liquidity stands going into the end of the year. So yeah, see exactly like Q's broke that back in. Q's lose 275. You see that fair value gap at 275. If the Q's lose 275, yep, right about there. That's significant because I think that if as long as that holds, right, you could gap and go turn it right there and turn back up. But if that breaks down, then you got a pretty impulsive retrace. As impulsive as it went up, it came back down. That's unsubstantiated volume. That's not it wasn't accepted. And that means that might be something significant. So TBD, but I think it's tactical. I think you could trade that short from like 290, that hole at 289 right there. That might fill, right? So I think you're going to see a lot of juking, like we call it Barry Sanders. You see a lot of Barry Sanders moves this week, right?
All right. Thank you so much, Jonathan. I will talk to you on Tuesday. We'll do your presentation after the 15-minute mark. How's that?
Okay, awesome. Sounds good.
All right. Have a great night, everyone.
Thanks, everybody. All right. Thanks.
Bye.
Bye.